Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. As companies and investors continue to navigate the 3D reset themes of decarbonization, deglobalization, and demographic change, Schroders believes that it is important to consider the practical investment implications of these broad themes. In 2024, Schroders sees investors transitioning from simply thinking of ESG risk management and integration to an increasing focus on sustainable opportunities and themes to harness for value creation. But sustainability need not be simply a growth-chasing exercise. In fact, Schroders believes that the asset managers who succeed in 2024 will be those that can deliver active management alpha around both valuation and sustainability objectives for clients. As a result, Roberta Barr and Alex Monk are focused on balancing both value and sustainability considerations in their portfolios. On the one hand, they agree that in the long run, the price you pay for something really matters. And at the same time, they believe that it's important to invest in sustainability leaders, companies that can deliver positive societal benefit and are best in class versus their peers, and will therefore be better placed to navigate change in the future. Hello, Roberta and Alex, and welcome to the Sustainable Finance Podcast.
Thank you for having us, Paul.
Yes, it's a pleasure to sit with you today and have this discussion. And let's go right into the questions because we've got a lot of ground to cover. The first one is, what does Schroders mean by value investing, and why do you think it's important? Roberta, why don't you go first, and Alex can comment on this as well.
Yeah, well, certainly. And maybe just for a bit of background about me to start with as well, so people know where I'm coming from. So I sit within Schroders' value team, which is essentially a sort of specialist value boutique that sits within Schroders' sort of broader equities powerhouse. And the whole philosophy of the team, the only funds that we run are value funds, and they're all underpinned by this deep-rooted belief that value investing over the long term will significantly outperform for our clients. And we do that by following a rigorous, disciplined investment approach where we only buy companies that are in the statistically cheapest part of the market. But within value funds, I personally only run sustainable value funds, which I do recognize is a little bit niche, but honestly, I think is one of the most exciting, underrated corners of sustainable investing out there. But maybe if I sort of firstly take a step back. So as I'm sure many of the listeners will know already, there are countless academic papers which indeed conclude that by investing in only the statistically cheapest part of the market, you could have significantly and repeatedly outperformed over the long term. So this chart that we're showing, all it's basically showing is a cyclically adjusted price to earnings ratio metric of the market, and then the 10-year annualized returns as a proxy to demonstrate exactly that. So on the far left, we have the cheapest cyclically adjusted price to earning buckets, the cheapest parts of the market, going up to the most expensive parts of the market on the right. And you can indeed see that 150 years worth of data is pointing to those lowest cyclically adjusted PE areas, those far left-hand buckets, or the deeply undervalued companies that could have, over the long term, seriously outperformed the market. But whilst this chart and its conclusion is nothing new, something that I actually find really interesting about it is that despite covering 150 years, this chart says nothing about politics. It says nothing about inflation or interest rates. I mean, the internet was only existing in its current form for less than a third of that 150-year time horizon. It covers the dot-com bubble, at least 2 world wars, possibly 3 now. And actually, very relevantly for us, this chart says nothing about sustainability or ESG. And, maybe we can go into a bit more detail later in the conversation, but certainly what we found in the Schroders value team is that it is certainly possible to still tap into that value premium, that sort of value alpha creation from investing in those left-hand parts of the market, while still maintaining a really high bar for sustainability. So we only hold in our sustainable value funds what we believe to be the most sustainable companies out there in the market. And honestly, it has been such a pleasure to be able to offer our clients that sort of style diversification in their portfolios. This is just a Morningstar style mapping chart, and all it's showing is the funds run by Schroders Value Team, including our Global Sustainable Value Fund, which is that lighter green dot. And for the 2+ years they've been running this portfolio, it has always been in that far left-hand side of this chart, that sort of strong value part of the market, along with all the other funds run by the value team, which I think certainly a lot of our clients have appreciated when they invest in other sort of thematic sustainability themes, which are exciting and inevitably quite growthy. Actually, by also holding a sustainable value fund, they've been able to balance their sort of unintended style biases that they create in their overall portfolios. And they have something that can zig in performance when other funds are sort of zagging, if you will. Now, I could probably go on and on about this for ages, but it's probably best if I do a little pause so that Alex can jump in as well.
Perfect. Thanks, Roberta, and thanks very much, Paul, for inviting us onto the podcast. It's a pleasure. I guess by way of background, from my perspective, so I sit in a slightly different team within Schroders to Roberta, which is our global resource equities team. We aren't a value team per se. We run various sort of resource equity strategies, including a global energy fund, which I guess is historically associated with maybe value investing, but also an energy transition fund, which is maybe associated slightly more with sort of the growthier side of the style spectrum. But one of the things that we consistently believe, whether we're investing in conventional energy or sustainable energy, very similar to what Roberta has mentioned, is that in the long run, the price you pay for something still matters, regardless of what area of the stock market that you're investing in. And what I wanted to do is just illustrate this with a bit of an example, and maybe we can jump to sort of the next slide down to sort of show this. So what this slide shows is the performance of conventional energy, sustainable energy, and the broader market over time. And then the valuation, very simply in terms of an EV/EBITDA multiple that you were paying for those different subsectors over the course of that same history. Now, if you start right at the beginning, which is sort of in 2019, sort of before the COVID pandemic, actually valuations between sustainable energy and conventional energy were not too dissimilar. You were paying about 6 times EV/EBITDA for the conventional energy space, about 8 times EV/EBITDA for sort of the sustainable energy space. So, relatively similar. Yes, a slight premium for the sustainable energy space, but actually, given the growth outlook, probably a justified premium. And actually what that meant was that we then saw sustainable energy outperform, because you were paying a pretty similar price for 2 different rates of growth, if that makes sense. We obviously saw conventional energy prices fall quite swiftly post-pandemic, and we obviously saw the excitement around some of the sustainable energy space as a means of driving growth because of policy support. So you ended up with a situation where actually sustainable energy kind of grew, almost 100% in terms of returns, between 2019 and the end of 2020, while conventional energy underperformed significantly. Now, what we then ended up with at the sort of beginning of 2021 was a situation where sustainable energy had significantly re-rated. And suddenly you were buying the same companies, but at a significantly higher price, and arguably a price that had become too expensive. And equally, in the case of conventional energy, you were buying exactly the same companies you were 2 years ago, but at a significantly lower price. You can see that they derated slightly. So what we actually said on the team was, okay, actually, yes, we still believe in an energy transition that's going to take place over the next 20, 30 years. But at the moment, you're just overpaying for some of these companies. So let's be a little bit cautious with respect to allocating there, and instead focus more on the sort of conventional energy space where the valuation looked far more compelling. And needless to say, what's happened, I guess, over the course of the next 2-3 years is that conventional energy has significantly outperformed because you were buying it at a much more attractive price, whereas in the sustainable energy space, you were buying things on a much more expensive multiple. And what's really interesting today is that after that underperformance of sustainable energy, we're now back to a situation where the multiple you're paying for sustainable energy is now much more reasonable again. So again, we're constantly essentially looking across this resource equity spectrum and saying, look, we really like energy as a complex, both conventional energy and sustainable energy. We know that the growth rates are going to be slightly different between the two subsectors, but regardless of where we're investing, whether it's in sort of the sustainable energy space and that exciting thematic, or sort of the more value-focused side of conventional energy, let's make sure we're paying the right price and being really disciplined with respect to valuations, because that is going to influence our future returns. So a different philosophy to sort of maybe Roberta's team, who are sort of deep value investors, but the same kind of overarching idea that the price you pay, regardless of whether you're investing in sustainable things or non-sustainable things, really, really matters. And the next slide just again illustrates a little bit more about a sort of us as a team. Again, these two energy sort of strategies that we manage, and then a food and water strategy as well, just to give you a bit of a flavor for what we do more broadly. Again, investing across that sort of resource spectrum, but again, with a very valuation conscious way, regardless of whether we're investing in sustainable parts of that spectrum or less sustainable parts.
Okay, so that's a lot of information that we're trying to absorb at the moment. And I think it raises a couple of questions. The first one, of course, is how does that make the two of you as portfolio managers and members of your respective teams think about sustainability? And why does it matter in the context of value investing today, where we are today based on all of this past history and going forward at the moment in 2024, as we described the overall experience that you're hoping your investors will have with Schroders in 2024?
Perfect. Well, I'm happy to take this one first, Paul, and maybe jumping on to the next slide. So I guess when we think about sustainability, I've always found it useful to break that sustainability component into two parts. And on the next slide down, you can kind of get a picture of what this is. So again, those two parts can be divided into what a company is doing. So what are their activities? Are they drilling oil and gas out of the ground? Are they building wind turbines or solar panels? Are they involved in sustainable themes or not? So essentially, that's really practically looking at where a company derives its revenues from and where its sort of earnings are going to come from a macroeconomic perspective, a top-down perspective. And there'll be certainly some companies that are exposed to activities that are going to grow quicker, and there'll be companies that are exposed to other activities that will grow slower. Some of those activities may be sustainable, some of those activities may not be. So that's kind of the first pillar of sustainability, sort of this thematic alignment, and whether companies are involved in activities that are sustainability aligned and therefore potentially creating value for society, and equally whether there are companies involved in less sustainable things that are maybe detracting from society in terms of social value. And then on the other side, you have how companies are doing things. And this is more about essentially the way that companies do business, how they manage their employee base, how they think about their supply chain, their customers, for example. Now, the reason I always find it useful to divide sort of sustainability into these two parts is that you could have an oil and gas company, for example, that was kind of viewed as not necessarily being sustainable in terms of what it was doing, but it might be running its business in an exceptionally sustainable way. It might be managing its emissions of footprint. It might be attracting the best employees through attractive incentive schemes. It might be managing its supply chain really, really effectively, thinking about sustainable sourcing of its equipment. And equally, on the other side, you might have a solar company or a wind company associated with a sustainable theme, but that was doing all the wrong things in terms of how it was doing. If you imagine a solar company that has a super high emissions footprint, is using forced labor or sort of conflict minerals in its supply chain. So it's really useful, I think, to divide sustainability into these two parts. One around sort of what a company is doing in thematic alignment, the other more around ESG integration and how a company is doing things. And these two things matters because they're going to influence earnings and they're going to influence valuations in very, very different ways. Maybe just jumping onto the next slide to illustrate this in a little bit more detail with an example here. So if we think about what a company is doing and the drivers of earnings because of that, and this will come on to our discussion about valuations later. What I've shown on the left-hand side of this chart here is how we expect electricity demand to grow over the next 30 years as we go through our energy transition. And clearly, over the next 30 years, we expect electricity demand to maybe double or triple as we start using electric vehicles, or even just all the excitement around data centers and AI. That's going to require lots of electricity. So what we would argue is that companies exposed to that growth of electricity that generate their earnings as demand for electricity grows by providing bits of equipment or by producing those electricity will grow their earnings quicker than companies may be exposed to fossil fuels, which aren't going to necessarily benefit from this growth in electricity demand. So again, what a company is doing is going to influence your earnings growth, and that's going to matter in terms of the price you pay for companies from a valuation perspective. On the right-hand side here, what we also showed was ignoring subsector, so forgetting about what a company was doing, whether companies that were best in class in terms of how they do things can also generate a better return. And that's because they're better at managing supply chain issues, they're better at managing kind of controversies, they're better at managing risks. And what you see across the different subsectors of our energy transition universe in this case is that regardless of what the company is doing, whether it's making solar panels or batteries or bits of electrical equipment, because it was doing things in the right way in terms of managing its business correctly, they tended to outperform. And that's again because they avoided some of these business risks that are associated with poor business practice. So again, dividing into what a company is doing and how a company is doing it, different drivers of returns and different drivers of kind of end business outcomes, but really important in terms of thinking about valuations. So I'll pause there and hand over to Roberta in case she wants to add a couple of things there.
Yeah, I'd just say one of the many things I really like about being an investor at Schroders is that you're given complete autonomy over building your own investment process, sort of coming up with your own investment philosophy and thesis. But then I watch Alex talk about sustainability, and him and his team, a group of exceptionally smart, deep thinkers. I think maybe this is a compliment for our team. We've come up with a very, very similar way to think about sustainability. I think our one is a little bit blunter, perhaps. We just say, in our sustainable funds, we'll only hold an ESG leader, which both does more good than harm. So as a net positive benefit to society, and by society, we mean sort of social things, but also environmental. And it has to be best in class versus its industry peers. So very similar to what's the company doing and how's it doing it. We're just saying that we want companies which are really directing their operations, their business practices towards being companies that are producing good in the world, positive externalities, and doing so in a sort of leading way within their industry, really leading the way to the most sustainable future for their industry peer group. And I think one thing we do often get asked is, well, actually, as value investors, there are some very attractively valued companies out there which are sin sectors, so say tobacco or gambling, things which you probably can't hold in a sustainable portfolio. And kind of the theory is, well, if you can't hold some of those, most attractively valued parts of the market, then actually as a value fund, you're going to underperform. And there is some truth in that. We all know that as soon as you begin to reduce your opportunity set, you do reduce your potential to outperform because, realistically, an unsustainable fund could hold the exact same as a sustainable fund and other options. But actually, something that I think is really interesting is that it's really important not to over-exaggerate that difference. What we've done here is we've taken a sort of proxy value portfolio, so the cheapest 20% of the market, and we've looked at how that performs when it's totally unconstrained. So over 30 years, that totally unconstrained value portfolio outperforms the market by 5.2%. So a good outperformance. If we then add on a whole host of exclusions, so no alcohol, no utilities, no oil and gas, no thermal coal, no gambling, like more than you would ever exclude from a sustainable portfolio in reality. Well, actually, that constrained value portfolio outperformed by 5.0%. So not the 5.2% of the totally unconstrained portfolio, but only 0.2% less. And I think that's really important because it highlights that value investing is so much more than just the sin sectors. There are so many other exciting opportunities out there in the market where you can still tap into that value premium just without having to compromise on your sustainability credentials. So I guess from my perspective, despite only holding companies which we think do more good than harm, we're certainly more than able to tap into that value premium and generate alpha from that value alpha let alone any alpha that you might get from sort of the sort of things that Alex talks about, and he's much more knowledgeable than me about, those sort of more growthy, sustainable areas.
Okay. So I think what I'm hearing you say, Roberta, is that there is the potential for sustainability leaders to trade at a valuation premium, and perhaps they should be companies that you expect will be able to do that over the long term. Is that correct?
Well, so I would probably flip that on its head, just because I'm a contrarian value investor. I would probably say, is there still opportunity within the sustainability leader space to invest in a deep value sort of alpha generating way? And obviously, I absolutely think that there is, since I do run a sustainable value fund. So actually on slide 9, what we've done is we split the market again into quintiles, so the cheapest 20% as Q5 going up to the most expensive 20% of the market Q1. And then in each of those quintiles of the market, we've counted the number of companies which have got AAA, AA, single A rated and so on, MSCI ESG scores. And just to be clear, I do not think MSCI ESG scores are perfect by any stretch of the imagination. But you know what? They are industry relative, and directionally, they do get it right. So they do sort of highlight which companies are ESG leaders, if you will, within their fields. And something which I think is fascinating, and certainly, clients that I've shown it to are pretty amazed as well, is actually in the cheapest 20% of the market, there are more companies which are A, AA, and AAA rated by MSCI than there are in the most expensive 20% of the market. I mean, that's not to say that there aren't companies which today are trading on such a sort of sustainability premium, they aren't value anymore. It's just to say that the majority of the time, when the market falls out of love with a company or even a whole sector, like say pharmaceuticals, it gets so worried about the product pipeline, it will throw out the window the ESG profile of the company, and it will still massively discount it onto these sort of dirt cheap multiples, despite the company being a sustainability leader. And I think that's a sort of very powerful thing that still happens, because it means we can still find those value opportunities even within the sustainable parts of the market.
I think this slide is probably the most important slide to some extent that we're going to show, in that it speaks to this idea that just because you are a sustainable business, either because of what you're doing or how you're operating, doesn't necessarily mean that you have to be expensive. Yes, we know throughout history, and particularly recent history, that at times there will be a sustainability premium put on names that are exposed to sustainable themes or operating in sustainable ways. But I think our job as investors, when looking to generate the best alpha in terms of sort of client returns, our job is to say, okay, we know that this is a fantastic business doing amazing things in terms of what it's doing amazing things in terms of how it's doing, but even with all that, we don't want to pay as much as the market is currently valuing it. So let's see if we can find some businesses which are still doing fantastic things, both in terms of what they're doing and how they're doing it, but find ones that are trading at a really attractive price, so that we can then benefit from the sort of valuation re-rating or the earnings uplift that comes through picking those businesses that might still be sustainable, but are just less loved today. So I think, again, that this slide is so powerful from Roberta's team in terms of showing that ability that just because you want to invest in sustainable things, you don't always have to pay up for it. You can find sustainable businesses that also screen attractively in terms of price and get that sort of double benefit.
So now we're talking about Schroders' approach to active ownership as an investor in the sustainable value space as well as elsewhere. Let's talk a little bit about that, because I think one of the things that our audience is always eager to understand is, what is the trade-off or the difference between active ownership and other approaches to portfolio strategy? And either of you can start here.
Roberta, happy for you to go first, and then I can maybe chip in with some sort of energy-related examples if helpful.
Yeah, of course. I think, it's a really good question, Paul. And we do often get asked how about a value improver strategy? Would you build a fund that essentially invests in ESG laggards, and then you apply this huge amount of pressure through engagement and active ownership to try and drive those companies to be, a bit better on the sustainability spectrum? And surely the delta there in sustainability, and by trying to get, the dirtiest company you can think of to be slightly less dirty, surely that delta is, the most important sustainability delta that you can make. But I must say, I struggle a bit with that idea, not because I don't believe that delta would do a great thing for society or the environment, but more from my investor standpoint. Ultimately, our role, Alex and I, what we're trying to do is we're trying to create value for our clients. We're trying to create great returns. And I think you have to put some element of trust in the management of businesses. Something tells me that actually, if, say, you took a thermal coal company, if the most economically sensible thing for them to do is to sell off all of their thermal coal plants and move straight to wind or straight to solar or something like that, then actually you'd probably be seeing signs of that today already. Probably those sort of ESG absolute laggards aren't moving that way because it's just not economically sensible for them to do so. Either they would come across too much, pressure from different stakeholders like employees, or just financially it doesn't make sense. And so actually, from an economic standpoint, I think that whilst that sort of social delta from the ESG laggard is tempting, actually I think that we can both create value for our clients financially and make a sort of positive delta, if you will, through active engagement by engaging with companies which are ESG leaders already. So companies where they're already moving their businesses to be sustainable businesses, and they might just need a little extra push. So we've had great examples of companies where, for example, they're interested in setting a biodiversity policy, but they just don't really know how to go about doing it. We can say, well, actually, we invest globally. We've seen your peers in Asia start to come up with these initiatives and think about these sort of metrics. And we have those sort of conversations where we're saying, as shareholders, we're seeing this as a huge emerging area in sort of sustainability world. We think you have potential to be an absolute, global leader from a sustainability standpoint. Actually, we think that could have some financial benefits for you as a company as well. And that's a much more collaborative conversation that we're having. It's far less confrontation. And not that I'm afraid of confrontation. It's just that you want everyone to be working together for a positive societal and financial outcome for your clients. And I think that's a really actually quite hard balance to make, and one which I think is certainly much easier to do when you're investing in ESG leaders, where the stars are aligning anyway, than trying to invest in an ESG laggard and going and telling, management company who've been running that business or working that industry for 10, 20 years that I, as a value investor sitting in London, know better than them for their business, which I think is a very arrogant game to play sometimes.
Alex, what would you like to add?
Yeah, I mean, I totally agree with what Roberta's saying. I think, as investors, we take a view on, the future outlook for a business, and we may have our own opinions, but ultimately these management teams that we're speaking to have been running these businesses for many, many years and understand the nuances of their businesses, better than anybody else. So at times, putting trust in a management team, if you have that trust, can be very, very helpful. I think where active engagement, can be useful as well in the context of value investing is identifying value traps. I know Roberta and I have had sort of discussions around this as well. In some cases, things are cheap because the earnings are in a state of perpetual decline. And those value traps are really important to avoid when you're value investing as well, because they're things that can suck you in when the price looks cheap, but actually that price is just going to keep getting cheaper as the earnings fall, based on sort of the earnings decline. So I think where active ownership can be really important as well is understanding whether businesses that look cheap are perhaps either making changes to ensure that they don't keep that earnings decline going and they can benefit from sort of that earnings, cyclically rebounding and re-rating their businesses, and even just understanding how management teams are incentivized. Ultimately, by having these discussions with management, we can understand where management are looking to allocate capital. And I also would say, I think this works in reverse as well. So as well as avoiding value traps, we have to have these same commentaries and discussions from an active ownership perspective with sustainability leaders. We certainly saw probably over the course of the last 3 years during the sort of sustainability bubble to some extent that we saw a little bit in 2020 and 2021, as I showed earlier, where companies in sort of the sustainable energy space were spending money on things that didn't overly make sense because they were sort of sucked up into the hype as well. So I think our job as investors on the other side, as well as trying to avoid value traps, is making sure that when companies do really well and their share prices go up, they don't sort of get too euphoric themselves and start spending capital on things that don't make sense from a financial return perspective or start changing their business mix and ultimately suffer when the sort of valuations sort of unwind. So those discussions with businesses are really, really important to understand how companies are managing their own businesses and how they're thinking about sort of different exposures, ultimately to be able to grow their earnings and return value to capital. And the right approach may be actually stick with what you're doing. We ultimately believe that that's the right thing. Or the approach might be, you know what, as investors, we're not comfortable with this approach. We're worried it's a value trap. And then either we give our opinions or we step away from the investment.
I would absolutely agree with what Alice was saying. And I don't want it to make it sound like I was anti-engagement at all, because I absolutely think there's a lot of value to be had in those sort of conversations. I think it's just such a powerful tool. You have to be very careful how and when you use it.
Well, I think that engagement has proven to have a lot of value, if I may say that, on both sides of the coin when it is used effectively and properly, and as you're both suggesting, at the right points in time, and not try to convince companies to run their businesses in a way that they know historically is not going to be productive and profitable. So now that we've dug into some of the considerations here, can you offer us some exciting investment opportunities that you're currently seeing and that you view as sustainable value?
Alex, do you want to start? And then
Perfect. I can start, and maybe if we could jump 2 slides down, please. Mm-hmm. Perfect. This is the one. So this is just a kind of couple of charts that combine the valuations across our conventional energy universe and our sustainable energy universe. And you can see the relative ranges on the left-hand side of this screen in terms of where they've traded from trough to peak and where they are now. And on the right-hand side, you can see where they're trading in relative terms versus their forward growth. And what we've done here is we've colored sort of sustainable energy in green and conventional energy in blue. And this is probably going to be, I guess, a little bit of an unusual thing to say, but actually where we're starting to see interesting relative value is in sustainable energy. It's been really interesting that, as I say, over the last 2 or 3 years, the valuations across the sustainable energy space have gone from record highs, again, you can see that on the bars on the left-hand side here, to now almost trough multiples. But actually, a lot of the forward earnings growth hasn't massively changed. So what's really interesting now is you're starting in some sectors, not all, to almost be buying sustainable energy on similar multiples to what you're buying conventional energy, given the sort of outperformance of conventional energy over the last couple of years and the potential outlook for sort of the conventional energy complex. So again, hopefully just illustrating this point that what I think sustainable value investing is about at its core is combining those 2 elements. Sustainability can be value, it can be growth. Value can be sustainability, it cannot be. It's about trying to find the combination of the 2. And I do think one of the interesting areas within sustainable value at the moment is actually the sustainable energy space, just given sort of how much the valuations have come down when the forward growth outlook hasn't massively changed. we still think there's really interesting opportunities in conventional energy as well, particularly those businesses that are really thinking about the energy transition and really working out where sort of the capital that they're deploying can be used most attractively. Particularly those oil and gas companies that are involved in building out carbon capture and some of these other things as well. They're paying really strong distributions at the moment, benefiting from the cash they're generating today, but also looking to the future. But it's just interesting when we look at this chart on the right hand side of this slide that actually the multiples are starting to kind of normalize out a little bit and actually look quite similar between those two spectrums. But you're definitely getting a lot more growth in the sustainable energy space. So value is what you pay for future growth and distributions. And again, I always think that's sort of interesting in the context of combining and looking at these two energy spaces that we do.
Maybe if I just add a sort of few regional and sort of more broader sectoral areas of interest we've been seeing as well for the value funds. So one area that we have historically been very underweight, and it's been a real shame, has been the US. But actually recently we've seen more and more names come up, sort of high quality, who previously really loved really great businesses, American businesses, in sort of mid, very cyclical space, which are going through an awful time at the moment. And that doesn't mean that they're not still great companies at their core. Maybe they sort of overexpanded a bit and they're having to simplify businesses back down. But actually, when we dig through those, there are plenty of opportunities where they're going through a rough time, but they've got the balance sheets in place, they've got the sort of right strategies in place to survive. And I think we've been delighted to begin to sort of top up on our US weight actually in our sustainable value fund. And maybe sort of for sectors as well, including sort of within the US. I think one sector that we're particularly bullish on is telecoms. And from a value perspective, you can get some really, really cheap companies in the telecom space at the moment. But actually, I think they're really underappreciated for the sort of sustainability profiles of those companies too. So the World Bank, I think, showed in some research that for a 10% increase in broadband penetration in a company, and keep in mind, in the US today, over 10% of the country's homes don't have internet connection today. So a 10% increase in broadband penetration, you'd roughly expect to see a 1 to 1.5% increase in GDP per capita. So a huge societal benefit that these telecom companies can offer when they're thinking about things like rural coverage, how they can try and get good, reliable connections to sort of more remote areas, or how they can make sure they reestablish connections, after natural disasters like earthquakes or hurricanes and so on.
I mean, I think Roberta makes some really interesting points there in terms of sectors that historically maybe haven't been associated with exciting themes or whatever it may be, but actually under the surface are providing real value for society and actually are quite sustainable businesses, are going through some of these transformations all the time, but that's not reflected in the price. I mean, we see something very similar. I know I've spoken about energy. We see something very similar in our food and water space, where actually lots of these businesses that provide essentially the things that keep us alive in terms of food and water, are trading at very, very cheap multiples, despite growing their earnings as we start to go through a period where the world needs more food. We're all getting wealthier. We want more food. We want more sustainable food. Lots of these businesses are sort of going through their own transitions under the surface, but are trading at really attractive multiples because the market hasn't quite clocked on to the fact that these changes are going through. Very similar to kind of Roberta's example in telcos, in terms of maybe some of the services that these businesses provide. And I think that's probably where both Roberta and I get most excited, when we find businesses that we view to be sustainability leaders and really creating value for society, and we almost can't believe how cheap they are. Because if you looked at sort of a similar business, maybe in a sort of more newsworthy or sort of sexy theme to some extent, they'd be trading at a much higher multiple. So it's always important to sort of look below the surface and really try and identify those businesses where, yes, you're getting a sustainability leader, but also there can be really exciting value as well.
Okay, Roberta, anything else to finish up here?
No, I think that ending's perfect from Alex.
Okay. Well, listen, Roberta and Alex, The next thing that we want to know is where online can followers of the Sustainable Finance Podcast learn more about the focus and opportunities being explored in 2024 by the Schroders Value Investing Team and Global Resource Equities Team? And how can they get in touch with you with questions about the topics that we've discussed in today's podcast conversation? Alex? Or Roberta, go ahead.
After you, Roberta.
I would point you straight to Schroders' website, which provides some great resources on both the strategies that Alex and his team run, as well as me and the value team, as well as some sort of broader pieces, economic research, thought pieces, and so on.
Okay. Yeah, I mean, I'd reiterate that. I think, what Schroders do, we produce, all sorts of content, videos, written work. You can find out all the information about all the different strategies. So, obviously, go there and have a look. And if you have any more questions, reach out to whatever your Schroders representative is. And we try and be as active with interested investors as well. So, if there are questions, please ask them. We're always happy to be here and answer them.
Okay, well, thank you both very much. And also, if you have any recent research or white papers or blogs that you would like to have us attach to this program when it gets dropped, we'll be happy to include those on the Bright Talk channel. So thanks again very much to Roberta Barr and Alex Monk of Schroders for joining me in today's episode. And our followers can stay tuned to future conversations with Schroders' Sustainable Investment Team throughout 2024 right here. I'm Paul Ellis, and this is the Sustainable Finance Podcast.